everyone. In this knowledge snippet, we would be discussing about taxation aspects of mutual funds. Today, we will be covering two funds, equity-oriented mutual funds and debt-oriented mutual funds, and we will see how they differ in terms of taxation. But before that, if you are new here, please subscribe to my channel Formulating Finance and don't forget to press the bell icon. Remember that equity is more of a wealth generator. That's why it is very aggressive. And if we compare it with debt mutual funds, it is more of a safer investment and it is basically done for regular income. The first category is equity-oriented mutual funds. They invest your money in the shares of different companies. If you sell the units of an equity mutual fund after 12 months, then you have to pay long-term capital gain. Remember, tax authorities always prefer long-term horizon. Your returns from redeeming units of equity-oriented mutual funds are exempt up to Rs 1 lakh in a financial year. For example, over and above Rs 1 lakh in a financial year will have a capital gain, that is long-term capital gain, of 10%. Let me explain this with an example. Suppose on 1st January 2020, you bought 10,000 units of equity-oriented mutual funds at the NAV of Rs 50. After 1 year, when you want to sell that, NAV is Rs 70 and you're willing to sell all the 10,000 units. So your returns are 70 minus 50 into 10,000 units. That is Rs 2 lakh. You have earned Rs 2 lakh. When we calculate the taxation effect, so 1 lakh would be exempt because it is long-term horizon, that is 12 months have passed. So you have to give tax on only Rs 1 lakh. 1 lakh into 10% is Rs 10,000 is your tax. Point to be noted here is the category we have talked about is non-tax saving equity schemes. In market, there are various other schemes also available which give you a taxation benefit, which is popularly known as ELSS, Equity Linked Savings Schemes. But these schemes come with a lock-in period of 3 years. That is, when you have bought the units and you cannot sell them before completing 3 years from the date of purchase. These schemes give you benefit when you are investing in them. The taxation benefit is only when you have invested, but they don't provide you any taxation benefit when you redeem them. Next issue is, what if you sell the amount or the units before 12 months? If the horizon is less than 12 months, it becomes a short-term horizon and you have to pay short-term capital gain tax, which is 15%. Hence, if you compare, if you take an early exit, you have to give more taxes. That's why I told you before, tax authorities always prefer for investor that they should hold on the investment for a long-term horizon so that they also pay less taxes. Now, let's move forward to debt schemes and find out how these debt schemes are taxed in India. Remember, we will be discussing about pure debt schemes, which is the most of the funds of the schemes are invested in the debt portion only. The holding period to enjoy a favorable rate of long-term capital gain is higher for debt schemes, that is 36 months instead of 12 months in equity. What we can understand is that companies usually need debt for a long-term horizon. Hence, it expects mutual funds to invest in them for a longer period and there is no exit anytime soon. If you sell units of a debt fund before 36 months, it would be considered a short-term horizon and you have to pay short-term capital gain. The gains which will be added to your income and you will be taxed as per your income tax slab. So, if you lie in 20% category of income tax, then these gains would be taxed in the similar way. But if you hold the units for more than 36 months, that will convert your horizon into a long-term horizon, and you have to pay long-term capital gain of 20%. Further, you also get the benefit of indexation. That is, your buying cost will increase because your buying cost will be linked to an inflation index. I hope you got the better understanding about the taxation aspects of equity-oriented mutual funds and debt-oriented mutual funds. If you think it was a good video, please like the video, share with your friends and family, and subscribe to my channel Formulating Finance, and don't forget to press the bell icon. Thank you all.